Let's have a quick overview of bonds. What is a bond? A bond is a security issued by an issuer to raise money. The issuer can be a government, bank, or company. When you buy a bond, you're lending money to the issuer. In return, it pays you a coupon, which is interest, every 6 or 12 months. The issuer repays the principal, which is the money you invested, at the maturity date. There are many different types of bonds. Let's cover the bond terminology you need to know. The issuer is a government, local government, bank, or company that's selling the bond. The principal is the amount that you invest in each unit of the bond. The maturity date is the date on which you get your money back. Denomination is the value of one unit of the bond, say 10,000, 100,000, etc. Denomination is the minimum amount of the bond you can buy. Increment is the additional amount you can invest in a bond. So you have to buy at least one denomination, and the increment decides how much more you can buy with each denomination. The coupon is the annualized interest rate paid on the bond. The market price is shown as a percentage of its denomination. If a bond is trading 5% above the value of its denomination, this will be shown as 105. The clean price is the quoted price of the bond, excluding the accumulated interest. That's what happens usually. There may be exceptions. The dirty price is the price you actually pay to buy the bond, which includes the accumulated interest. So if you buy a bond quoted at 105, 105% will be multiplied by the denomination, and to it they will add the amount of interest that's accumulated since the last interest payment or coupon payment date, and that's the price you have to pay to buy the bond. But when you receive the interest, you will get the interest all the way from the previous interest payment to the present interest payment date. The settlement date is the date that the bond is delivered to you. What are the different types of bonds? There are government bonds issued by governments, municipal bonds issued by local governments or municipalities, inflation-linked bonds where the principal of the bond is adjusted by the rate of inflation. When the principal is adjusted, any coupons it pays is also calculated based on the adjusted principal. Then there are zero coupon bonds. These bonds don't pay interest, but they're issued at a discount to the denomination. So when you receive the denomination back at maturity, you are receiving the interest in the difference between what you pay and what you get. Then there are foreign bonds. Foreign bonds are bonds issued in one country by an issuer from another country. And there are corporate bonds, which are normally issued by companies. Convertible bonds are usually issued by companies. If the share price of the company goes up, the convertible bond can be converted to a particular number of shares of the company. If the price of the shares hasn't gone up, the bond repays the principal just like an ordinary bond. There are asset-backed bonds, which are often issued by banks, where the principal is secured against a pool of mortgages, credit card debts, car loan, and what have you. There are subordinated bonds, which pay a higher interest, but if the issuer goes bankrupt, the principal is paid after the principals on all unsubordinated, i.e. senior bonds or loans have been repaid. So they carry a higher risk, so they pay a higher coupon. Green bonds are issued to raise money for climate-friendly and other environmental projects. Social bonds are issued for socially important projects like affordable housing. Catastrophe or CAT bonds are bonds that pay a higher coupon but could lose some of the principal if certain defined catastrophic events like earthquakes, hurricanes, floods, forest fires, etc. occur. Sometimes these bonds are issued by insurance companies who are underwriting certain risks that have a small probability but high consequence. Let's look at the government bonds issued by the world's top 5 economies. These are the United States of America, China, Japan, Germany, and India. US government bonds include Treasury bills or T-bills with maturities of 4 weeks to 1 year, Treasury notes or T-notes with maturities of 2 to 10 years, and Treasury bonds or T-bonds with maturities of 20 to 30 years. There are also Treasury inflation protected securities or TIPS with maturities of 5, 10 or 30 years. These are bonds whose principal changes with the rate of inflation. It can go up or it can go down. And the coupon that is paid is also linked to the adjusted principal. There are a number of different types of Chinese government bonds. There are Treasury discount bonds or Treasury bills with maturities of 3, 6, and 12 months. There are Treasury bonds or T-bonds with maturities of 2 to 30 years. There are local government bonds with maturities of 3, 5, 7, and 10 years, and policy bank bonds, typically long maturity bonds issued to finance projects by certain banks. Japan has a huge government bond market. There are short-term government bonds with maturities of 3, 6, 9, and 12 months, medium-term government bonds with maturities of 2, 5, and 10 years, long-term government bonds with maturities of 10 to 40 years, and Japanese government bonds with inflation protection or JGBI with maturities of 5 to 20 years. There are also floating rate bonds with maturities typically 1 to 5 years and retail bonds or J-REITs with maturities of 1 to 10 years. German government bonds include German Treasury bills or Bubills with maturities 3 to 12 months. There are Schatz with maturities of typically 2 years. Bobbles or Bundesobligationen with maturity of 5 years. Bunds with maturity usually 10 years but up to 30 years. There are also inflation-protected bonds with maturities of 5, 10 or 30 years. There are also German municipal bonds, which are called German states or Länder bonds, with different maturities anywhere between 1 and 30 years. Indian government also has a very sophisticated bond market. There are Government of India Treasury bills or T-bills with maturities of 3, 6 or 12 months. There are Government of India savings bonds with maturities of 2 to 3 years. There's Government of India bonds or G-SECs with maturities of 5, 10, 15, 20 and 30 years. There are inflation index bonds, maturity around 10 years or more, and there are state development loans or SDLs with maturities from 10 to 30 years. And finally, there are savings bonds or retail bonds with maturities of 5 to 7 years. Let's look at a few foreign bonds. Yankee bonds are bonds issued in US dollars by foreigners in the US. By foreigner, I mean governments and corporations from outside the United States. Samurai bonds are issued in Japanese yen by foreigners in the Japanese market. Panda bonds are issued by foreigners in China to raise yuan. Dim sum bonds are issued by foreigners in Hong Kong to raise yuan outside China or offshore renminbi. Euro bonds are bonds issued in euro by foreigners in the European market. Euro dollar, Euro Swiss, Euro sterling, Euro yen bonds are bonds issued in international currencies by foreigners in the European market. Bulldog bonds are bonds issued in British pounds by foreigners in the UK market. Kangaroo or Matilda bonds are bonds issued in Australian dollars by foreigners in the Australian market. Municipal bonds are issued by different states or provinces in a country. They are usually issued in the local currency. They are used to borrow money for specific projects like developing housing, roads, bridges, railways, dams, airports, renewable projects, etc. Many municipal bonds offer attractive coupons and tax advantages to encourage investment by the public. Corporate bonds are issued by companies. Most large companies issue bonds in different currencies. Even companies that do not have their shares listed issue bonds that could be listed. Corporate bonds are used to borrow money for projects, general use, or to raise money in a particular currency. The coupon paid depends on the financial health and credit rating of the issuer. Companies with better financial health pay lower interest on their bonds. There are more bonds in the world than there are shares. Even though people focus so much on shares, there are many more bonds, and the total value of bond markets around the world is larger than the total value of the stock markets all around the world. Bonds are used by all governments and many companies. It is very important to consider learning more about bonds and integrating them into your investments.